All right. Hi, everyone. Welcome to day 3 of the 30 Experts Favorite Indicators event on TimingResearch.com, brought to you by TradeOutLoud.com and TimingResearch.com. So just a quick reminder, these presentations are for educational purposes only. Trading is not suitable for all people, and please consult a financial advisor and only trade with money you can afford to lose. And as always, all of the sessions are being recorded individually and will be available on TimingResearch.com. Also, if you search for Timing Research on YouTube, Substack, or your favorite podcast app, you can find the recordings there as well. So to open the day for us today is Price Headley of BigTrends.com is here, and happy to have him here. So go ahead and turn over to Price.
Well, thank you, David. Always a pleasure to be here for these timing research events, and great, great lineup today, folks. So make sure you stick around throughout. And the goal of all of this, of course, is to focus on patterns of what has worked across a lot of different markets. And so I'm going to share with you one of my favorite patterns. When you're talking about favorite indicators, I consider any even price action pattern to be an indicator if it's repeatable, right? If it's a setup and a pattern that you can find on a regular basis, and knowing that we're going to have winners and losers, right? We have to look at how we manage risk on every trade in addition to how much we can make. I always want to go in thinking about what can I lose first versus what can I win, because the win versus the loss setup, we can construct that favorably. So let's get into it, talk about how you can use same week options. These are options that will expire each and every Friday, but where we're going to look to be in and out quickly in 48 hours or less, looking for doubles in what we're purchasing in the option. So as we get things started, of course, we talk about, the upside and the downside. Just want to remind you that the information that we provide you in today's presentation is based on our proprietary research, and it's intended for illustrative purposes only. What we talk about here should not be considered specific advisory recommendations. As you know, stock and options trading have large potential rewards, but also large potential risk. The past performance of any trading system or method is not necessarily indicative of its future results. So do see our terms of use on our bigtrends.com homepage for more information here. So today we talk about indicators. I'm going to share with you this favorite price action pattern. So a pattern that has to have a kind of a variety of filters and setups here to then ultimately where I can consider it an indicator that I look for to repeat with a variety of different names. I like to say that the symbols will change, but the pattern remains the same, right? So the idea is that, okay, you can rotate amongst a variety of sectors and stocks. You see what's happening in the tech sector, right? We had a great run until right before the CPI report just a couple weeks ago. CPI report came out completely benign, just showing almost no inflation, and yet you saw this massive rotation out of tech and into the small caps. So you have to know how your pattern is setting up to position you into the right sector, the right stock. That's what I'm going to share with you across my 35 years of stock and options trading experience today. Show you a bunch of case studies and success stories of what worked, and also when it didn't, what do you do? And we call this strategy quick options doublers. So we're looking for these quick options trades where we're not going to hang around very long, and we're looking to leverage them with the weekly options. So you can learn this trading strategy and how you can start taking advantage of these quick options trades right away. Towards the end of the presentation, I'll tell you about that. But if you don't know about me, I've been trading stock and option trades for 35 years. I remember I started in April of 1990, and then started BigTrends.com nearly 25 years ago, back in November of 1999. My philosophy, everybody's talking about AI and artificial intelligence is all the rage and the hype right now, right? But basically, when I was launching Big Trends at the end of the 90s, I was seeing the power of computers to say, look, you can scan through hundreds, if not thousands, of situations to get your best one or two ideas at a time. You don't have to get into too much of like, I better buy a whole bunch of stuff. I'd rather not do that, actually. I'd rather focus on a trade or two at a time and have that be where, we're pulling out the best of the best from our scans and through the power of computing, right? So, and then using this unique pattern and option strategy to take advantage of it. For me, quick history lesson on where my interest developed. I was a student at Duke University. This was right after the crash of '87, a trading competition got the AT&T Collegiate Investment Challenge. I think it was about 14,000 students were in this thing, where basically I got interested and said, okay, it's November 1st, 1987. The market just crashed. What's the right strategy? Well, I figured Warren Buffett probably would be a good place to start and say, okay, let's just buy. I remember buying Coke, buying Gillette, buying Procter and Gamble, and then thinking you can't go wrong buying those, right? Well, I got my statement with a month to go in this 4-month contest. I'm 3 months in, 75% of the way done. I'm in the bottom 20% bottom 25% or whatever it was of market participants going, okay, there's that old phrase, if it ain't broke, don't fix it. Well, in this case, it was broke. It was not working. I better fix it. I better do something different. So you have to look at yourself, what's working in your portfolio strategy, what's not working. And if you're seeing sustained problems with the philosophy, for me, the value buying, this was just paper trading stocks, right? So this wasn't even yet kind of seeing the power of options and how I could leverage my stock analysis with options trades. But basically saying this buy and hold and wait stuff, especially on stuff that's broken down, can cost you not just a lot of potential further downside when you're buying dogs, but it also can cost you a lot of just relative opportunity. If I value buy something and you wait a year and it's up, say you eventually it's up 10, even 20%. Well, if you could have bought something else that's up 100%, you've got a big opportunity cost, right? Opportunity costs on your money is so important to realize. It's about what you could be doing. So for me, I went into an active trading mode and basically said, let's just see what happens. And there's a lot of hype on takeovers back then. This is February of 1988. And basically I said, look, this is a bunch of hype. This is probably not going to play out. Let's scalp it back down. I was quick trading back then, before anybody was really talking about it, as a way to wealth, but saying, you know what, these short-term patterns were repeatable, and I finished in the top 1% on that contest in just the last short month of February, right? And I think my grades might have went south while my portfolio went up, but the point is, I found my passion at that point and said, look, this is so. I graduated from Duke, became an analyst, and ultimately head of research for the nation's largest options newsletter at the time in the 90s. And then really I kind of needed a little break in 99, left after 9 years there, and said, look, it's time for me to kind of consider my next options, play golf for a while. Realized I love golf, but I don't love it enough to make a career out of it. I wanted to be back in the markets, and said, you know what, launched Big Trends in November 1999, coming up on a full 25 years in business, and a lot of folks to thank for that. So many tens of thousands of fellow traders and investors. Also blessed to be featured in Barron's Magazine, September 11, 2000, a year to the day before 9/11. Never forget that date. But bottom line is that I said watch out below because we had a big change in sentiment after Y2K had passed. Everybody thought it was safe to go buy the techs. I've been mentioning in recent weeks that I think far too many people got too far stretched into the bullish AI slash Nvidia trade, if you will, the big semiconductors and the magnificent seven. They haven't been so magnificent for the last couple of weeks, right? Does that mean they're dead forever? No, but it just means you've got to be aware of the risk, right? You've got to be aware where there's a shakedown coming. We're seeing that shakedown right now. So in fact, it's probably getting a little overdone in that from a short-term perspective, and where our price action pattern would say we're not ready to buy it yet, but be prepared. We might get a potential reversal soon, and then we might have an opportunity to trade the bounce. So the key, though, is you got to be flexible. I attribute my 35 years in the game to being flexible. Also blessed to be inducted in the Traders Hall of Fame, sponsored by Traders Library back in 2007. Joined a lot of my trading heroes. And what I would kind of look at today for you and really this entire event is about learning from others, both lessons of what worked and what didn't, right? When you can look at patterns that you think you can also implement, then, that's where you can get potentially save a lot of hours of your time and get to your goals a lot faster. So that's what we're at. I would encourage you throughout the event today to really put your full attention onto it. Commit yourself to really learning from many decades of experience collectively among all the different fellow traders, if not centuries. Bottom line is that you look at this and say, okay, so everybody thinks they can multitask effectively. The reality is multitasking lowers your IQ. We're here today to boost your trading IQ. I mean, fellow traders and speakers. So definitely make sure you turn off those other distractions and get focused. Let's kick off today's special event with a recent winning trade example. Then I'll go more into how quick options doublers work. So, Boeing's been beleaguered, right? Boeing has been, through this whole problems with their 737 MAX jets and safety issues. And the reality is, okay, what we look for with this pattern is we look for momentum that's shifting, right? So in this case, what we're looking for is we're looking for at least 2 hard candles up or down to go with some other setups here. So you see we had 2 hard candles down on Boeing here, and we actually had several closes in a row lower, right? Even this prior bar was a close underneath the previous close. So if you don't know about candles, of course, a red candle means you're open. If we look at this last one here, your open was higher, your close was lower. That's the red candle body there. Of course, you can see your high and your low too, right? The green green and white candle would mark, of course, an open over on the left that's below where we close, right? So that's the difference where you got positive momentum building. So, but one bar doesn't make a trend, one candle doesn't make a trend. You're looking for some type of a pattern where you say, okay, we want to see that things are starting to reverse, in this case to the downside, and then we're getting that strong 2 bars in a row of red candles on the downside, right? Breakdown candles. So it tells us at that point that here we are, second close there. Stocks trading in the neighborhood of about 183. Notice we were recommending to buy the 182.5 strike puts. Of course, Boeing is a high dollar stock. Of course, 100 shares would cost you over 18 grand, right? We were controlling 100 shares of stock, buying the 182.5 puts for less than $200, right? So your theoretical leverage here is about 100 to 1 as it starts. Now, of course, there's always going to be the risk of time erosion when you buy an option. If you've ever bought options before, you know that, of course, time is not your ally. So you've got to get your moves happening relatively quickly. The reason we like this strategy so much is because we know we're not going to be in for more than 2 days. So as a result, what we do with quick options doublers is we say, look, we can trade the weekly options that are going to expire on that given Friday. Of course, like right now, for example, there's weekly options expiring tomorrow. That's cutting it a little too close probably for us. It's possible we might make a trade this afternoon and be right back out tomorrow. But a lot of times we'd like to give ourselves a couple of days to let this trade play out. So you can see these options are going to expire at the close on the 14th of June. We bought it on the 12th. So you say, okay, gee, you've only got 2 days left before the expiration. And you say, yeah, but that's where your leverage is. You get a lot of bang for your buck, especially when you can call out more than just a half point or even a 1 point move. We're oftentimes looking for multi-point moves here. So you really take advantage of the kind of growing leverage as these options go from near the money to in the money. You're going to pick up a lot of what's called delta, meaning a lot more bang for your buck on this excessive, not just point in your favor, but even 2 or 3 points in your favor. You can see the next day, after we bought these options for $185, controlling 100 shares, quoted at $1.85, but each option contract controls 100 shares. You got to multiply times 100 for what your cost would be. So it's $185 to control 100 shares by buying that June week 2 182.5 strike put. Remember, with a put, if you're new to options, it's a right to sell the stock at that fixed strike price of 182.5. So we're saying, look, we think it's going a lot lower than that. You see the next day it trades down here almost to 179, maybe 179.5. And you say, well, you can see quickly on the 13th, that thing has popped from 185 to 370. We've gotten our double. So it's moved on the option just under 2 points, or the fact that the stock moves about 3 points, right? So the beauty of this is that, of course, you're just trading the stock. At best, maybe you could have made almost 2%, and you're turning instead this into 100% gain, 50 to 1 plus leverage, because you're basically hitting it correctly and quickly. And also, we are hopping out when we get our double. We do not try to just trail stops. We don't try to take partial profits and hold on to some. We say, look, let's go ahead and take the whole position out when it doubles. So if you're putting $1,000 in at maximum, then you could have bought 5 contracts in this case. It would have cost you $925. That $925 turned into $1,850 for a $925 profit. all these examples are before commissions, but as you know, commissions are down to $1 or less a contract with no ticket charge anymore. It's never a better time in my 35 years of options trading experience than now to be an options trader, because you keep the vast majority of what you make. You wouldn't pay more than $10 at maximum in commission round trip on this trade. And if you get more active, you should contact your broker to ask for a discount, because I know people that are paying, like myself, 50 or 60 cents a contract. But the bottom line here is that when you look at this, you say, okay, that's in 24 hours or less, right? We'll get into these trades a lot of time right near the final hour of the trading day, because this is a daily chart. We're looking at a daily chart pattern, and we're making sure that the daily chart pattern on the second day, hard candle down, confirms what we saw the day before. So we're going to talk more about examples, but let's just kind of dive a little deeper into kind of the philosophy of this system with quick options doublers. One of the reasons it's been popular here at Big Trends is because the options are cheap and you can get quick bang for your buck. So small accounts can trade this very effectively, just like medium and larger accounts can. We trade liquid active names. So as you're a larger account, yes, you can participate in that with a lot more contracts too. The key is be consistent in your capital allocation. We're suggesting for a starter account, say you were starting with a $10,000, $5,000 or $10,000 account, you might put in up to no more than $1,000 a trade, and just kind of keep on sticking with that, even as you hopefully grow your portfolio, or even if there are drawdown phases, there will be both, that you just kind of stay consistent with your capital allocation and allow yourself the ability to see your portfolio grow over time while not getting too high or too low off of any one trade. You see our average contract price year to date so far in 2024, over almost 7 months now, has been less than $2 a contract, less than $200 controlling each 100 shares, right? So that would get you an average of at least 5 contracts per trade if you're putting $1,000 in. Same week options really give you plenty of leverage potential. That's what allows for these quick profit targets of a double. Obviously, we're trading options that were a month out on that same move we just showed you in Boeing. You might expect your leverage to be cut by a factor of 3 or 4 times less, buying, say, 4 weeks at a time versus a few days of time. Okay, so that's something you have to kind of keep in mind, is that it's a trade-off. You know, you might make less, you might also have less risk too. So the key is you've got to manage your risk as well as your reward. We're going to talk about both today. Like I said, we start with a daily chart because we find that the daily chart is really the bigger picture. Wars being won on a day-by-day basis, where there's a lot of intraday skirmishes or battles being fought intraday. The war is won at the close. You know, that's why a lot of times you'll hear that the first hour of the trading day between 9:30 and 10:30 is often called amateur hour, because a lot of traders that don't know any better are putting stops off the prior day's low or high, getting flushed out, and then the big institutions are making their moves a lot of times in the final hour. So we want to be with those bigger institutions to say, look, where's the true trend being determined? Who's really winning the war at the end of each day? Let's align ourselves with those bigger institutions. Let's face it, they're the ones that are driving the market, not you and me as individual investors and traders. The big institutions moving a lot more capital are going to drive the market. And you say, well, don't they know more? Aren't they going to be in and out faster? The reality is the big institutions will have to, a lot of times, build their bigger positions over many days, if not weeks, because they don't want to splash all the water out of the pool. So we will get our new trades out in that final hour, usually between 3 p.m. up to no later than 3:45 p.m. Eastern. We prefer 3 to 3:30, really, because we want to give you enough time when we send a real-time email alert to say, get into this. Here's the exact option you should buy. Here's what it looks like. Buy this option at this price or less. We'll then also tell you, okay, here's your target. Here's your stop. If you know exactly what you're shooting for, you know exactly where you get out of a trade, win, lose, or draw, you're never left hanging. So the daily chart allows us to avoid a lot of the intraday fake outs and really focus on reducing market noise. You know, as a 35-year trend trader, nothing irks me more than basically getting whipsawed out of a trade by market noise and then seeing the trade that I was on go on to my target profits while I'm stuck on the sidelines, right? To me, that's the thing that we're really trying to make sure that you have staying power to stick with these signals and to know that if it's going to stop you out, if it's going to hit your target, okay, that's the objective. You know, follow the stop, follow the target, but don't worry about the little blips in between. We've got plenty of wiggle room for the trade to move either in our favor, or if it does stop us out, it's a legitimate stop out. Save your capital and go on and move on to the next trade, right? So you look at this and you say, okay, so from this perspective, we're saying, okay, we're going to focus on the true trend. The other thing that we spend a lot of time on, that you could say, well, sure, you could do this from home, and over time we'll teach you how you can do it yourself in addition to the trades that we call out, so you can do this, but it takes time, right? My team of analysts and I, what we do is we do something we call profit factor filtering. What is that? Well, profit factor is a combination of several key things, but especially a lot of people ask me, what's your win percentage? That's only part of the equation. Win percentage is important, but what's also important is winning bigger and losing smaller, right? If you can create a bigger size of win to loss ratio on average that's in your favor, then in our case, if we're shooting for a double 100% gain versus a 50% loss, that's a 2-to-1 size of win to loss ratio, right? That's our objective. And you say, well, okay, if you've got that, even if you had a 50-50 win rate, you still can make good money in the markets with a 2-to-1 size of win to size of loss. So the idea is that there's multiple things going on. We look at a stock's history on its profit factor, and we filter for that over the last 10 years or more of past signals for that stock, and a variety of stocks that we follow, right? The big name stocks that have plenty of options activity. And so the idea is that, okay, if that stock works really well in the system, we're ready to fire when that next trade comes out. There are some stocks that don't work as well in the system. If it's not significantly better than a coin flip, we're not going to trade coin flips or worse, right? We're going to make sure we put the odds in subscribers' favor, knowing that we can't guarantee the next trade based on a really good past profit factor. We know there's going to be wins, there's going to be losses, but it's about playing the probabilities, putting the odds in your favor. So what's our specific setup that we're looking for here? We like to see consecutive higher closes for long signals. So we're talking about multiple close after close after close in our favor, at least. And then the opposite for shorts, right? We're looking at breakdown signals on the short side. And we're saying, okay, we're going to look for back-to-back green bars for bullish long signals, buying a call. The red bars where we're showing that, and we mentioned that weaker close relative to where we opened, finishing on the downside, looking for back-to-back of those going into a bear trade, buying a put. So the idea here is that, okay, the exact settings are proprietary. I can't give that away for free here, but when you get on board, I do give you all the settings and the parameters. You know exactly how to follow this along for home gamers too. You say, well, why should I care? Well, when we look at the performance since inception, knowing that past performance looking backwards never guarantees future results looking forward. Future results will vary. They could vary more or less than this. I think it could be better or worse. But the idea is that based on our history, we've got a lot of confidence here, because you see from the 1st of January of 2020 through yesterday's close, you say, okay, this is the performance. If you just stuck with every trade we called out, win, lose, or draw, you put in no more than $1,000 into your options trades, every quick options doublers trade that was called out, your $5,000 portfolio would have returned over $24,000 in profit. You'd be up to $29,384 gross portfolio value. This is all winners and losers and break evens added up, and factoring in everything except for it's not factoring commissions, and it's not factoring what you pay to access the service, right? The subscription costs. So those things, obviously, like I said, the commissions are down so much that doesn't worry me too much. And of course, we've got a great, attractive, low risk offer for you here at the end to help you start taking advantage of it and keep the vast majority of your money working for you in your trading account to benefit from it. So again, just always remember that the way you can mess up a good system is by not being disciplined. If you're running too much capital into a trade, and then the next trade you're saying, I don't like that one, I'm not going to take it, that's where you're going to get yourself in trouble, being inconsistent in your capital allocation. So I would rather see a new subscriber start really small, like smaller than you think you need to. Even if you traded one contract at a time for a couple $100 on average per trade, that's better than, say, putting in 2001 and then passing on the next. You play that pick and choose game, you're probably going to pick the wrong ones, or enough times that you're going to get frustrated and then probably give up. Frankly, that's the worst thing that can happen in my view, is give up on an overall good performing system. So keep that in mind. But let's talk about some more trades, and the chart tells the tale with it better than 1,000 of my words, because let's look at these pictures here. This one's actually surprising, even to me, when I look back at like a stock like Apache. Here we are in the oil and gas sector, right? APA is the symbol. This is back in early May. It looked like the stock had broken down, right? Based on these 3 hard candles here to the downside. And our setups actually in this one would have said that we were too late by the time we got our 3 or more lower closes and the 2 red candles. That would have been a bad time to buy to buy puts on that X, right? But as it came back up, you see that it does actually have a higher close here on 0.1 the day after that low. 0.2, of course, is a higher close, and 0.3 is a higher close. You look at that and say, okay, and there's our 2 green candles happening here, right? So we've got the 2 positive momentum candles here. So by that second positive momentum candle, the stock's trading about 30.25. We're buying the 30 strike calls. That's on May the 7th. That was a Tuesday. With the expiration of those second Friday in May was May the 10th, right? So the May 10th is our expiration day. And you say, okay, so we're in on Tuesday in the last hour of the trading day, buying those 30 strike calls, about a quarter point in the money. We're paying a half point for it. So what does that mean? It means that if it had finished exactly where we got in at 30.25 by Friday's close, 3 full trading days later, we'd be losing 50% of our investment. That's the risk you're taking, is that there's time decay while you're waiting for that move to play out. Where do we need it to go? We need it to go intrinsically up to about $31 to be safe that, yes, it's going to go from 30 to 31. It's going to rally 3 1/3 percent. And that's what's going to give us this option's got to be worth $1 when it trades at $31, right? We've got a 30 strike call. It's a right to own the stock at 30. At 31, it's worth that full dollar. So we pay $50 a contract to be worth $100 a contract to double when that happens. Notice it started to grind up over those next couple of days, got to maybe about 30.9 on that Thursday. And on Friday morning, the day of the expiration, Friday morning, it tagged like 31, 31.10, something like that. So we're out at $31 and sell it at $1 on the morning of May 10th. So this is where, we had enough runway to take advantage of that improvement in the momentum. And it was a good thing that we booked it before it reversed, right? If you had held it into the close, you see that it would have finished down in the low 30s and you would have actually lost money on the trade. So we took the double and ran, right? So you put in on a $50 investment per contract on $1,000 total invested. That would get you 20 contracts, not counting commissions, right? But 20 contracts at $50 a piece is $1,000 invested. You turn that into a double, you make $1,000 again before commissions. Like we said, 20 contracts in, 20 contracts out, no more than $40 a commission. In that case, you'd still pocket $960 after commission at worst. Okay, and hopefully better as you get more active, get that commission rate down even lower. But still, that's still holding on to 96% of your total capital even after commission. So the point is, while past performance never guarantees future results, our next APA trade could be a winner or a loser. We're going to be consistent in allocating to this and say, look, we were playing the bounce back because the momentum had shifted back to the upside. So it does allow you to take advantage, therefore, of a lot more of these patterns where the markets are oscillating. We're in the summer season. I expect a lot more of this oscillation. I mentioned some of that tech volatility and saying, you know what, it's going to be here. But don't think that now tech's going to go down forever. It's going to get a snapback at some point too, right? So here's a tech example with Amazon. So we can trade the biggest name stocks in the marketplace here. You can see that that what we were picking up here was that even though it looks like a red candle that happened like a few bars back, that was a higher close than it was by just a hair the prior bar. And then we got our 2 green candles, right? Our first one here, and then our second one, I'll put a 2 on that as our second green candle. Into that close, stock's trading around 178.15 to 178.25. And we're recommending to buy the 177.5 calls. So what do we pay for that? We paid, this is the March week 4 options, by the way, we're going to expire at the close on March 22nd, 4 p.m. on that Friday is when the market closes, right? We will never take these options into the expiration and say, oh, you should just acquire some stock. It's a great time to own the stock. No, that is not our game here, right? We're not going to tie up that kind of capital, right? To own 100 shares of Amazon will cost you just under 18 grand. And you say, okay, well, look, we're going to buy the 177.5 calls. We're paying just under $2, $1.85. So if you're putting $1,000 in, that would mean you invest $925 plus your commission, and now you're betting that Amazon's going to rally. Well, interestingly, on this one, we're picking up this momentum pattern, folks, because our data shows that we have a pretty good odds of a follow-through move in our favor the next morning. There's no guarantees, but we think the odds are, based on history, are in our favor to capture some continuation momentum into the following morning's open. You can see the next day, closing just above 178, it opens near 180. Now, we don't get our target profit there yet, right? Because at 180, 177.5 calls just intrinsically are worth 2.5. Yes, there was some time premium in there too. It might have been trading closer to $3 off of that open, but then it ran up to 181.4. Now you can see, if you think about what does this thing need to be, even if we had no time value left, what does it need to be trading at? We exited at 370. That's our target relative to our 185 entry. So you say, well, 370 added on top of 177.5 puts you up to about 181.2. We traded that next morning to 181.4 on that Thursday morning, March 21st. We were ringing the register out at 370. Sure, some of these can keep going, right? But what you don't want to happen is what happened here. If you were passive, if you sat back and just held and hoped, then look what happens. By the close, it's right back down, red candle reversal, back down to where you got in the low 178s. Guess what? At that next Thursday's close, that next day's close, you would be down, because if it's flat and you've got time premium decay, you would be losing time, right? You would have one more trading day to go where you're grinding it out, right? And sometimes we have to grind it out into that Friday. The other thing is that we will, per what I said, we will never take it to the bitter end of the expiration Friday. The latest we could hold any of these trades is 3 p.m. on Friday, an hour before the market closes on Wall Street time. So the idea is, look, let's make sure that we're not going to put ourselves in a position of getting stuck in a trade into the expiration. We've got a game plan. So here's one on Bank America, where you can see here that Bank America, the banks have been a tremendous sector this year. You know, last year, everybody's worried about Silicon Valley collapse turning into the next financial crisis of 2008, right? And of course, it didn't materialize, despite a few of those banks having trouble. You know, the reality, of course, is that those banks, where their biggest problems have been, is the bond market, the bond holdings they have. If they have to mark those to market and they're sitting on big losses, right? That's still a factor out there to keep in mind. But what's happened is, if they hold into maturity, they'll be okay. More importantly, that you see, you can buy these bank options really cheaply. So you're getting new leadership in the banks this year, and yet they're not being priced like your typical leader or tech stock or other high volatility situation. You can see we called out a Bank of America 40.5 strike call back on July the 2nd. And this was an interesting week, because of course the July 4th holiday hit on a Thursday. So we were getting in on a Tuesday afternoon when you see all the momentum here, right? We've got multiple higher closes. The past 4 in this case were higher closes, but we've got our 2 higher candles, the 1 and then the 2 into the afternoon there. So the stock's trading here around 40.7, I think, when we called it out. Is about 20 cents in the money. We paid 29 cents on those options. 29 cents to control 100 shares of stock, where the stock would have cost you about almost $4,100, right? So even Bank of America gave you more than 100-to-1 leverage opportunity here going into that holiday week, right? That the markets were closing early on the 3rd, then they were closed on the 4th, but then they were trading on the 5th. Okay, the 5th was the expiration day. So I said, yeah, it needs to hit it quick. Well, you can see from 29 cents, we needed to turn into like 58 cents for our double. The next morning, it gaps up, and as we're getting our alert out, it's rallying up here to 41.2 at the high. You can see at 41.2, these options have to be intrinsically worth 70 cents. We got out at 69 cents, having bought it for 29 cents. So we made $40 a contract on a whole bunch of contracts, right? So on the $1,000 invested, it made you $1,360 of gross profit before commission. That was 137.93% gain, right? So that's above our double target. It can happen that you can make more than the double and the gap's in your favor. It can happen that you could lose more than your 50% loss if it gaps against you, right? So you have to factor both sides of the equation. Let's look at, we mentioned before that the time stop can kick in at Friday at 3 p.m. on a trade you're still holding where it hasn't hit its profit target of 100% or its stop. And so you have to keep that in mind too. So here's one with Corning, GLW, kind of a tech play, if you will, where you look at this and say, okay, we've got the 44 strike calls, and we've had this 2 monster days up on these green candles, right? The big gap the day before may have been tied to something like earnings, right? Well, we don't try to trade right in front of earnings with this strategy, right? We don't want the big gap against us. But if a big gap is in our favor and we're looking in the rearview mirror saying, yes, this momentum, bar 1 on the big gap, bar 2, candle 2 on the second day follow through, stocks trading just over 44.5. We're buying the 44 strike calls for $1.12, $112 a contract. So we need those to turn into 224, right? About 2.25. It needs to get up to like 46.25. It doesn't quite happen. And so you can see here that what happens is it rallies up to about 45.5, 46, maybe just in that zone. But then as it reverses back down that afternoon, look where the stock's finishing for the day, up around 45.6. So that would imply that this thing's going to be worth about $1.60. We actually got out at 3 p.m. a little bit better than that at $1.90. There's still even a bit of time premium left, even in those final hours on some of these situations. So you look at this and say, okay, that's not a double. It's a 69 2/3% gain, give or take. On $1,000 invested, it would make you $624 gross before commission. So the point is that you get the momentum in your favor. This strategy definitely takes advantage of reversals and then momentum follow through in your favor. That's what we're looking for. Not every trade is going to work, but the idea is that when you're catching that, you'll see that it's something that can be pretty quick and pretty fast moving in your favor when it works. So the idea is that, okay, and it works enough that we feel confident to say we can handle the risk relative to enough of these that'll hit their target or get close to it. This one got close, not quite there. C Limited, ticker SE. This is a 69 strike call. Notice we've now had the positive reversal here at the several higher closes in a row, and of course several green candles in a row showing the higher close above the open. So we're getting into that June the 4th entry point right near $70. We're buying the 69 calls. They're about $1 in the money. We pay $1.58, $158 per contract, right? So if you're putting $1,000 in, that would get you about 6 contracts in for just under $950, like $948. You can see, what do we need to happen? It needs to get just over 3, means it needs to get over 72 and change. Gets close, right? But doesn't quite get there. But we still get most of it and book an 80 1/3% gain, $762 in profit off of our $948 invested. So the idea is that we're cashing it out in that final hour. We won't just expect you to do it without us telling you, hey, it's time to get out of this trade. So we'll send you reminder emails. This is your profit target. This is your stop. Or, hey, it's time to get out of this trade. It's Friday coming here at 3 p.m. Go ahead and exit. Take this price or better, get on out and lock it down before the expiration. So again, past performance never guarantee future results. And also knowing that not every trade is going to win. We're going to have losing trades. People ask me all the time, well, why do you use a 50% stop loss? That seems too wide. But these options are fast moving and they can be volatile. The stocks can be volatile, as can the options, right? So you need to give yourself enough wiggle room to say, let's make sure we don't get noised out of an otherwise good trade. But let's also have enough of an uncle point to say, we just had a double. Let's not give all that back with a wipeout on the next trade, right? So we find that the 50% stop loss is a very reasonable one to do. Here's one that looked like everything was setting up really well on Shopify. And you say, well, gee, it could be market related. Maybe the market took a turn back down. Maybe something else happened. But the idea is that whatever happens, our job is not to make excuses to rationalize, well, it's still a good company, so therefore we'll still hold it, because a good company and a good stock are two totally different things. It's your job to say, okay, follow the discipline of, if it hits your 50% stop loss, get rid of the trade, salvage what you can, and move on. Don't let it turn into a total wipeout, right? So we got in on March 20th, expiration a couple days later, March 22nd. That's a Wednesday afternoon entry at $1.41, $141 a contract, buying the 81 strike calls, expiring 2 afternoons later, right? Well, you see in this case, the next day, it actually did rally intraday. You can see it went from 81.5, hit up to almost 83. And a lot of people say, oh, well, gee, you should have raised your trailing stop. Again, we find that if we do that, we're going to whipsaw ourselves out of too many good trades. So our rule is just give it the 50% stop loss, and then as it does reverse back down here, just back towards about 81, we're back to about a 70-cent exit there midday on the 21st, out at the 50 and a third percent loss. You can see some slippage where maybe you get out 51, 52, 55% loss, or if it gaps against you, it could even be worse. That's why I always remind subscribers, especially after good runs that we've had, never overcommit your capital. Never load up on the next trade because you're like, wow, they're hot, let's go ahead and load up on the next one. No, be consistent on your capital allocation. That will serve you much better to become a long-term beneficiary of this pattern that we've identified here. Another example where we caught some downside momentum, this was on CVS Pharmacy. And you can see CVS really was getting a massive reversal down. You can see that it has kind of the classic, like looks like it went higher than shot lower on that several bars back action, but you see red candles galore here as it's breaking down. A lot of people look at this and say, you're way late, Price. You should have already bought this put a while ago, right? Everybody has that fear of being too late. And there's the fear of missing out. There's also the fear of kind of being the last one to get in, and then the market turning on you the other direction, right? There's always that concern. Well, again, this is why I trade small amounts of capital. Stock trading here near 53.5. We're buying the 54 strike puts. Maybe it's 53.6. Maybe it's 40 cents intrinsic. Maybe about 13 cents a time here on May 28th. And you can see what's the play. Well, the play is we're betting that it'll go to $1.06, double our money, and it ends up doing a little bit better than that when it gaps down, gets us $1.10. So we get 107.5% on $1,000 maximum investment and make us $1,026 gross before commission. So the idea is that you can see it traded all the way down here at about 52 3/4. That means it might have been worth $1.25 at the high. Finished back just over 53, so it was worth about 93 cents at the end of the day. We took the $1.10 and ran, right? Bird in the hand thinking, right? Get the double, book him all. Don't try to hold and hope for more. So that's the philosophy here that's led to these long-term results. Remember, going back to the beginning of 2020, you've got the pandemic where the market got cut by almost a third. Lost almost a third of its value in about 6 weeks from the COVID pandemic, right? You got the 2022 bear market where a lot of 2023 was just making up for the losses of the prior year, right? So if you're a buy and holder and say, oh, it's worked out to buy and hold over 4.5 years, well, you could say, yeah, but you've had to endure some real white knuckle rides, and you also have had to endure a lot of basically just catching up from prior losses, depending on when you got in that phase. So my philosophy is, okay, that can be part of your portfolio that's that, but I think you owe it to yourself to be more proactive and get part of your portfolio really working more actively for you, and knowing that you're not going to be in the trade for more than a couple of days at a time, right? So you're not stuck kind of, getting underwater and then hoping it comes back. It's saying, look, we're going to have winners, we're going to have losers, but it's about executing a system that generated from a $5,000 account, turned it into more than a $29,000 account in gross value, $24,000 gross profit before commissions, before subscription investments. So factor those things accordingly, reminding yourself all the time that the past performance will never guarantee future results. Future results are going to vary. Could vary even more favorably or less. So keep all that in mind. Now, because this strategy has been so successful, and kind of celebrating this with the timing research event here, we wanted to give you a super exclusive way to get started learning and earning, right? Taking advantage of this and not being committed to a whole lot of capital outlay. We want to keep your money working for you in your trading account so that you see how it works. And then, of course, our belief is you'll want to re-up after trying this out over the next 3 months. So we're going to give you this super special kind of intro offer here to get 3 months of trade alerts from our service called Quick Options Doublers here, this pattern that we see replicating both on the upside and the downside on a regular basis, right? It's just going to be about helping you to see when the wind is at your back, right? It's all, as you probably have learned if you traded for any length of time, it's all about timing. Timing is truly everything. And so bottom line is that couldn't be more appropriate talking about timing research, having sponsored all the speakers here over these days. So timing really is so important. So when you get signed up, it's not a black box system. You will get the settings and rule sheet. We just ask that you don't share it with others outside your family. Use it for your and your family's benefit to make sure you're taking advantage of this and understand how it's working so you can really see it as it's setting up and coming into play. Now, remember, though, not every one of those potential setups is going to be something we trade if it doesn't check our boxes on our, especially on our profit factor filtering criteria, right? So that's what I feel like a lot of our subscribers are really paying us for here internally at Big Trends, to do that legwork, scan all those possible situations to find the best of the best profit factors, meaning that history says that the win rate has been healthy enough and that the size of win to loss ratio has been healthy enough to combined to give you trades that you feel like are stacked in your favor. So it's a probability game. There's going to be winners, there's going to be losers, but letting those probabilities play out over a large sample of trades. I'm also going to give you weekly video training. I update this for my Quick Options Doubler subscribers every Monday, and you'll get a member site access that you can log into and see my latest video, what worked, what didn't in our past recent trades, and what I'm expecting for the next trades. Also, whenever you've got a question about a trade that we call out, you can always reach me and my analyst team via dedicated email address. So if you bought this off of my Big Trends website, you pay $297 every month times 3 months. It'd be $891 out of your pocket. But I'm going to drop that down significantly for you as a way to say thank you to Timing Research for having me in today to lead off today's event, and say we're going to give you the 3 months of trade alerts. We're going to give you the 3 trading resources as extra bonuses to say you're going to truly get educated while you're getting trade alerts. You're going to also know why they're happening with the rule sheet. You're going to know what I'm thinking about the markets and what I think is coming next. Instead of paying $891, cross that out. It's just going to be yours today for only $177. Now think about that. We're giving you access over the next, 90 or 91 days for under $180. That's less than $2 a day, $177. You think also about what one trade can make you, right? It's one trade, you put $1,000 in, has the potential to make you $1,000 of profit gross before commission, right? So the idea is, okay, you can get an awesome ROI off of just one winning trade. And we're confident that, hey, even my biggest thing I want you to be thinking about is how do you make sure you're going to stick with the system? And so what I would request for all new subscribers is to actually start really small. So even on $200 invested, say on one contract, just to start to dip your toe into the water on a very, you can start with one contract, average of a couple $100 that we pay. Some will be more, some will be less. But the idea is that, look, a couple $100 doubles, it makes you a couple $100, you get your money back, and then everything else is gravy too. So you can start small, truly, and let the system prove it to you. Don't just take my word for it. So what we've done is we've set up this link for you here. It's not a www link. It's members.bigtrends.com. That's that member site access I was talking about. But members.bigtrends.com/quick. So what's really cool about this is that we keep our order pages incredibly simple. Okay, so let me just show you what this looks like when you go there. We've already taken the big savings from $891 down to only $177. So there's no other promo code discount to apply. Where this is as rock bottom as I can take it to say, look, you can try this out for the next 91 days, next 3 months, for less than $2 a day, $177 for the next 90 plus days. So the idea is that, look, okay, we want to have you know that we may have a trade later today. We may have a trade next week or 2 next week, right? We can have typically 1 or 2 trades a week. So we're not going to be trading every single day. We're going to focus you on the best of the best 1 or 2 opportunities a week, which would be about, we'd expect 6 to 8 trades in a given month. So over the course of a 3-month subscription, we'd expect that you get at least 20 trades. Okay. Again, that's less than $10, less than $9 a trade, but it's really about quality for us. And it should be about quality for you. I know a lot of traders are just hungry for action, action, action all the time. Do not confuse activity with results. In my 35 years of options trading, I've learned in my early days the hard way that too much activity can get you in trouble, right? You can be too defocused, having too many open positions on, and lose sight of what you need to do to take action, whether a winner or a loser is transpiring, right? Don't want to let your loser slip away. You don't want to let your winner slip away. You don't want to let your loser slip into small losers turning into bigger losers. So the idea here is that we make it really simple. This is a secure page. Like I said, we're on our 25th year serving our big trends community here. Secure page. We respect your privacy, respect making sure that your information gets transmitted securely. And also this PayPal link is the way that I do most of my online transactions, where you just can click PayPal, a few clicks later, boom, you've got the access to our very next trade. You get a welcome email, as well as you also get the ability to get a follow-up to set it up on your smartphone with smartphone alerts via the WhatsApp technology as well. No additional charge from us. So the bottom line is that $177 gets you access for the next 3 months. A lot of times I won't sell it for less than a year, but I'm giving you a chance to try it out for 3 months, and I think you'll be so satisfied that you'll be willing to pay more of the true price after the 90 days are up. So I'm convinced that you'll see the value. Remember how quickly you can see the value. Just one trade can get you that bang for your buck many times over. That 177 could turn into a multifold ROI opportunity. In this case, look, the CVS put that we had there at the end of May, 53 cents the next day turned into $1.10. That's $53 into $110 per contract. So you can see you'd be making over $1,000 off of just one single trade if you allocated no more than $1,000. We can't guarantee what the next trade will be like, but you know that you look at things over a longer period of time. This is from the beginning of 2020. You can see it takes you back and says, okay, through yesterday's close. I love how my team is so good about updating through our very latest close trade as of yesterday's close. So the bottom line is that it's just your job to say, how do you start taking advantage of this? And we've made it really simple. So like you can see, that was almost a 6-bagger, 496% gross return, almost a 6-bagger gross before commissions, before subscription investment. And the key thing to remember here too, folks, is that we never compounded it. We kept it at $1,000 per trade, whether it started at $5,000 account. Sure, that was more like 20% per trade getting started. But now with the portfolio up over 29,000, you'd be looking at something closer to 3.5% a trade, right? So you think about that, you say, okay, that could be even shown a lot bigger, but we're not going to do that. We're trying to keep your expectations reasonable. We want you to be in the game for the long haul, but I want you to try it for yourself so that you can truly prove it to yourself that this works across a reasonable sample of trades. I think 3 months or about 20 trades is a reasonable sample to apply and say, okay, if you don't see the value over 3 months, then we did something wrong. Guess what? We're always committed to our subscribers. Even after you get signed up, it's not a one and done. It's like every day we're in here, a new day starts, and we're ready to get you clarity about when to get in, clarity about when to get out. We never leave you hanging. You always know where you stand on every trade that we call out here at Big Trends for you with our quick options doubler program. So like I said, you're not just getting trade alerts, though. You're getting extra trading bonuses here. You're getting the rule sheet. You're getting the regular weekly video coaching and training from me. And then you're also getting the access to me and my team. If you've ever got a question, we're there for you, right? And not going into a bunch of automated voicemails. It's like, no, you'll reach somebody live. If you've got a question, you can call us toll free at our 800 Big Trends line. And let me remind you on that too, that how you can reach us if you're having any problems getting your order in. You need to act on this quickly by the end of the night tonight to really lock in this true value here. members.bigtrends.com/quick. On that order page, you'll see how you can reach us if you've got any questions. In the top right, pull it on over here. Top right, that's our 800 number. And remember, it's really easy to remember. If you can't remember that number, you should make a note of it now. That's for reaching us here at bigtrends.com at 800-244-8736. But if you can't remember, just remember 1-800-BIG-TRENDS on your phone. That'll get you to us at that number. You can also email us. My client care team helps with anything related to your own Big Trends account information. Remembering that's your Big Trends account with your subscription access. We have no touch of your actual trading account. That's under your total control. So what we're asking you to do is one thing and one thing only. Execute once you get these trade signals, right? We'll send them out to you, whatever. It's not dependent on any brokerage platform. Whatever brokerage platform you use to trade options in, you can use that. So it's basically saying, look, we'll say, go ahead and buy this option up to this price or less. Okay, then put your profit target at a double in, your stop in if it hits 50% loss. Neither hit will tell you at 3 p.m. on a Friday, okay, it's time for you to get out of that trade. Win, lose, or draw. We're exiting the trade, going on to the next one. So you'll know you're never going to be wondering what to do next. But if you ever have a question, you can call our 800 Big Trends line, or you can email us via clientcare@bigtrends.com. And I've got a couple of minutes left before I hand it over to our next speaker. So I wanted to see if we've had any questions here on the chat. Let me pop it in here on the chat. And thanks, David, for posting those links there for folks. Those are hyperlinks so you can easily come in. I want to know, are you trading options? If you've never traded options before, type a number in there. Type 0 if you've never traded an option before in your life. If you're in your first year of your options experience, type a 1. 20 years, type of 20. I like to know what the experience level is of our crowd. So we get a 0 right away, and don't panic. If you're brand new to options, this is incredibly simple to implement. Okay. So we've got some new traders. That's okay. The idea is that, look, you know that it's very simple, kind of read it to your broker instructions here, right? So the beauty of this, let me show you what my last thing I'll do here. Let me just show you what a trade looks like here. Okay. So I mentioned that Boeing example. Let's just show you what it looked like when we called out Boeing real quick. If I can pop that up here. So basically we look at that and say, okay, quick options doublers had this trade. Okay. So, so we have a situation here where we say, okay, here's what it looked like when we called it out. You'll get an email alert that looks like this. Now, this is an old trade, so it's not something you should do now. It's already, the option's already hit its expiration. But back here, right at 3 p.m., back on June 12th, we sent this email to all of our quick options doublers at the same time. We said, look, buy to open the Boeing June week 2, 182.5 put. We said pay up to $2.30 or less. Now, remember, we got filled less than $2. We give you room to get into these trades, folks. A lot of other services will say pay $1.85, and then, oh yeah, we got the $1.85, and then boom, it's on to $2 or $2.10 or $2.20. And so we want to make sure you don't miss it. We give you room to get in. So that's important too. You know, so you're not worried about, oh, they're just reporting something on a tracker that nobody could get. We use actual real world entry and exits after we send our alerts for an average price of what our subscribers were able to achieve. Okay. That's important as well. So for those who are new to options, know that you would literally just open your options account, basically say, okay, you could get into this trade, turned out for less than $200, but in this case, you would have assumed even on one contract, you put it in for $2.30 or less, you might invest $2.30 to get in. Now, if it races to 3, we wouldn't chase it to 3. We're saying don't pay more than the $2.30. Then when it's time to get out, we'll do the same thing where we'll tell you time to get out here. And so the exit alert looks something like this. Remember, we also mentioned that C limited one that worked. But basically, we've got our stop in on Boeing there at 92 cents. We've got our target at 370. I think C limited also ended up getting like 80% of that gain. I think GM might have been a stop out, right? So we've got multiple opportunities there where basically we guide you through when to get in, when to get out. You were never left hanging. That was off the next morning's open where you see, okay, you know what to do next. And so you don't have to worry. So even if you're working a day job, you're not going to have to commit much time to this. I'm out of time. I need to hand it back over to David so you can get it ready for our next speaker. Thank you so much for having me, David. I appreciate it.